Hey, Marilyn. I was thinking about this scenario, like a CEO, right? It's Monday morning. She's got this huge inventory, margins are super thin, and she's staring at this form on her laptop. It's the CAPE portal. And it's her way to claim her company's share of, like $166 billion in refunds? The Supreme Court ruled this past February importers were owed this money because of tariffs that weren't authorized. She's one of like 330,000 businesses in this exact spot this week. She's just reading the form, trying to decide if she should sign it.
Yeah, and that's the kicker, isn't it? Because just the Tuesday before, the president himself went on CNBC, and he explicitly said he would, quote, remember the companies that file. And he called the ones who declined the refund like brilliant and honorable. I mean, wow, right?
Wow is right. So she's got this like fiduciary duty to her shareholders, obviously. She needs the cash flow. She has this option on a statutory refund that literally the court says is hers. And then there's this televised threat from the executive branch. It's a wild setup.
Absolutely. And that decision fork for her, multiplied across 330,000 entities, like you said, that's just one of four measurable resolutions, landing inside this 90-day window. And what's wild is they all test the exact same thing.
So that's what we're doing today, right? By the end of this episode, listeners are going to be able to read a four-gate calendar. We're talking the FOMC decision next Wednesday, the ISM Manufacturing print on Friday, the Ninth Circuit ruling this summer, and the July 24th tariff sunset. And they'll know which gates are like compressing that gap between what the administration says is happening and what Capitol and courts have already recorded. They'll know what to watch for. They'll know what the resolutions mean.
And, they'll understand something that's even less comfortable, that the calendar itself, this idea that administrative pressure is being narrowed like gate by environmental reality, that might be the totally wrong frame entirely. We're going to get there. But yeah, 4 gates, 90 days.
Okay, so let's just name the 4 gates, right, and what each one actually resolves. First up, April 29th, 2 p.m. Eastern, Federal Open Market Committee rate decision. The Kalshi order book is pricing a hold at 3.5 to 3.75% at like 0.96. That contract's effectively closed. The only live volatility is whether the dissent count moves above 1. Governor Miran dissented from the March hold, preferring a cut. If a second dissenter joins him on the 29th, that internal coalition is cracking, basically.
Exactly. Next, May 1st, 10 a.m. Eastern, ISM Manufacturing PMI, April print. The Kalshi book, again, is pricing sub-50, which means manufacturing contraction at 0.68. The public narrative implied probability is like around 0.50. That's an 18-point gap that's been open for weeks, The underlying signal there is the prices paid index, which surged to 78.3 in March, highest reading in nearly 4 years. We're talking tariff pass-through on steel and aluminum. Panelists are holding headcount flat, running overtime instead of hiring.
Wow, okay. Then there's the Ninth Circuit. Consolidated oral arguments were April 16th on Nevada versus Kalshi, Robinhood, and Crypto.com. Ruling expected 60 to 120 days out, so mid-June to mid-August. Judge Ryan Nelson called the platform's framing sophistry to the nth degree. The Third Circuit actually ruled the other way on April 6th. So if Nevada wins at the 9th, there's an explicit circuit split, and the Supreme Court is virtually obligated to take the case. Kalshi prices cert at 0.42. Public narrative sits closer to 0.3.
And finally, July 24th. That's the statutory sunset of the Section 122 tariff regime. The administration pivoted to that after the Supreme Court struck down IEEPA authority in February. Section 122 caps the rate at 15% and time limits the authority at 150 days. The administration is just racing to stand up Section 301 findings as a successor framework before that clock runs out. So yeah, 4 gates, each priced, each with like a really specific thing to watch. Okay, so now, let me just press on the frame a little bit, Marcus. You've described this public-private price gap, right? Public narrative on one side, prediction market book on the other. 18 points on the ISM print, 12 points on the Supreme Court cert. The frame is that these are like 2 measurements of the same thing and one of them is wrong. But they're not measuring the same thing.
Oh, tell me more about that. What do you mean they're not measuring the same thing?
Well, a federal announcement, that's a declaration, right? A Kalshi contract, that's a revelation. They're different objects. Think about how a publicly traded company reports earnings. Management gives forward guidance before the quarter, traders front-run the release. When the actual number drops, the guidance either gets validated or it doesn't. If guidance is off by a mile, credibility erodes. Do it twice, you get a CFO change. Do it 4 times, you get a new board. That's, I think, a much better analogy for what these 4 gates actually are. They are not courts of reality arbitrating between 2 equally weighted claims. They are like scheduled earnings releases. Each one is a reconciliation between what the administration has been guiding and what actually clears. And here's what's interesting. A company with degraded earnings credibility usually tries 2 things before a new board comes in. First, it stops giving specific guidance. Second, it changes which metrics it reports. Both moves, they buy time, and both moves concede something about the underlying business.
Both moves also work temporarily, right?
Temporarily, yeah.
So these 4 gates, then, they aren't just measuring the gap. They're like stress testing whether the administration can still issue guidance that holds, then.
Exactly. They're stress testing whether that guidance has operational weight at all, or whether it's already become, just a press release about a quarter the company has, lost.
Now, let me pull on something that's not, I think, in the prevailing analysis here. The Kalshi litigation, that's being read as like a gambling law question, right? Is a sports event contract a derivative or a wager? Does the CFTC preempt Nevada's gaming authority? Judge Nelson reads Rule 40.11 out loud in court, and the platform's framing collapses. That's the surface reading. The second order question, though, is much, much bigger.
Okay, I'm ready. What's the bigger question?
Prediction markets, if they survive this, they become the authoritative, continuous pricing mechanism for public events. Elections, policy decisions, Supreme Court outcomes, ISM releases, Fed decisions, like all of it. The state currently holds a monopoly on the official price of most of those outcomes, right? The Bureau of Labor Statistics publishes inflation. The Fed announces rates. The court publishes opinions. The administration declares policy. A liquid prediction market prices all of those continuously, with capital at risk, with no state permission required beyond federal CFTC registration. So if Nevada wins the Ninth Circuit, the state retains monopoly pricing authority over at least sports events and the mechanism for continuous pricing in adjacent domains, elections, policy, judicial outcomes, gets a precedent that constrains it. If Kalshi wins, the precedent cuts the other way, and Kalshi already prices elections, Supreme Court outcomes, and macro releases alongside sports. So what's actually being litigated is whether the state retains monopoly authority over the official price of public events.
Wow. Project that out like 5 to 10 years. If prediction markets persist and extend, every federal announcement just becomes a reconciliation event against a continuously priced expectation. That's already how Treasury auctions work. That's how inflation break-evens work. Extend it to policy. A Fed decision doesn't just get announced, it clears a book that's been pricing it for weeks. An ISM release doesn't inform a market, it settles contracts. A Supreme Court cert grant doesn't surprise, it pays out or doesn't. The announcement effect just weakens, doesn't it? Guidance becomes negotiation with a price.
Right, a lateral connection. And this isn't, new. This is how sovereign debt markets already discipline fiscal policy in most developed economies. A finance ministry announces a budget, yields move. If the market doesn't believe the fiscal path, yields blow out before the bonds clear auction. The minister adjusts or pays the premium. This would bring sovereign credibility-style discipline to domains that have historically been immune to it. Judicial outcomes, regulatory decisions, election integrity.
Hold on. Does that mechanism actually port across, though? Treasury yields discipline fiscal policy because the state needs to borrow, right? The feedback loop is market disbelief raises borrowing cost, which raises fiscal pressure, which forces policy revision. There's a money loop closing. What's the money loop on a prediction market for a Supreme Court decision? There isn't one. The court doesn't borrow from Kalshi. A bad implied probability on cert doesn't cost the court anything directly.
You're right, there isn't a direct money loop, but it costs the Solicitor General's office reputational capital. It costs the administration narrative capital. Those aren't money, no, but they're definitely currencies.
They're currencies under very different conditions, though. Narrative capital is burnable in ways sovereign credit isn't.
An administration can accept a 12-point gap on SCOTUS cert probabilities indefinitely if the resolution is 6 months out, and the political incentives reward reality denial in the interim.
So the mechanism ports partially. The signal exists. The discipline lags. That's the second-order finding. The infrastructure for continuous pricing of policy and judicial outcomes is being built in courtrooms right now, and the discipline function lags the signal function by a lot. But it's there. So, okay, now I want to break something we built. The episode has been running on a frame. The frame is administrative authority is being narrowed by environmental reality, gate by gate. IEEPA got struck down. The pivot to Section 122 is capped and time-limited. Section 301 is being rushed. Each successor authority is weaker than the last. Capital and courts are compressing the runway. That frame assumes that shortening runways means weakening authority. What if shortening runways is the product?
Say more. What do you mean, the product?
The administration pivoted from IEEPA, an unbounded emergency authority, to Section 122, which caps at 15% and expires in 150 days. The conventional reading is that this is a contraction, right? The Supreme Court forced a weaker tool. But here's the other reading. A rapid series of temporary authorities is not necessarily weaker than one permanent authority. It can actually be stronger, because it just exhausts the opposition's capacity to challenge it. 24 state attorneys general filed suit against Section 122 at the Court of International Trade on March 5th. A business coalition followed on March 9th. CIT hearing April 10th. Ruling pending. By the time the CIT rules, Section 122 is already close to its July 24th sunset. Even if the CIT strikes it down, the authority has either already expired or is about to. Meanwhile, Section 301 findings are being rushed for completion before that sunset. If they hit first, a new authority is in place before the old one is adjudicated. The opposition spends its litigation capacity on authorities that sunset before rulings clear. The administration spends its time on the next pivot. That isn't a system being constrained. That's a system that has traded durability for velocity, really.
Okay, let me build the strongest version of the opposite case then. Velocity without durability is fragile, right? A Section 122 authority that expires on July 24th cannot impose tariffs on July 25th. If Section 301 findings aren't ready, the tariff apparatus collapses. Every pivot has a seam. Every seam is a vulnerability. Second, the CIT hearing was April 10th. A ruling before July 24th is possible. If the CIT strikes down Section 122 on statutory grounds, specifically on the consistently applied requirement that 24 states are arguing, that decision establishes precedent that constrains Section 301 as well. Section 301 is not a clean reset. It inherits jurisprudential weight from every Section 122 ruling. Third, the Section 122 cap at 15% is real. The 150-day limit is real. Treasury Secretary Besant said on the record that tariffs could return to IEEPA levels under Section 301. That statement is itself evidence that the pivot has not yet achieved what IEEPA achieved. Ambition outstrips infrastructure. And fourth, Congress can end this. The Pineda-Sanchez Stop Global Tariffs bill is in committee. A congressional vote makes the pivot question moot. So, there are counterarguments, right?
I hear all four of those, Marcus. Let me test them against what's actually happening. The seams argument. Every pivot has a seam, but the CAPE refund portal is handling the IEEPA-era seam right now, under the original executive, with 330,000 importers filing under threat of being remembered. That's what a seam looks like when the system is working as designed. The refund is statutorily owed. The refund is being contested in televised interviews. The refund is being filed anyway. The seam isn't a vulnerability. It's just a cost being passed to claimants. The precedent argument. CIT rulings on Section 122 constrain Section 301 only if the constraint doctrine ports, and the statutes are different. Section 301 does not have the consistently applied requirement that anchors the state AG's challenge, so the precedent doesn't port cleanly. The ambition outstrips infrastructure argument. This assumes infrastructure is the binding constraint. What if ambition is the operating mode? Besant's statement isn't just aspiration, it's guidance. It's telling importers and trading partners what the reversion path looks like. That shapes current behavior regardless of whether Section 301 ultimately delivers it. The congressional argument. Pineda-Sanchez is in committee. It has not moved. There is no evidence it will move. A bill in committee in April does not function as a constraint in July. So the steelman holds at the level of possibility, but the current trajectory is running against every one of its assumptions.
So the conflict doesn't resolve in favor of the original frame then.
The pivot architecture isn't being outrun by environmental reality, it's operating on a different clock entirely.
Right, and that's the harder finding, I think.
The gates still matter, though. They're still measurements, but they're measuring something different from what the episode has been, claiming.
Then measuring how long the current pivot lasts, not whether the system of pivots terminates.
Here's the actionable frame then. Watch the gates, but read them the right way. April 29th FOMC, watch the descent count, not the rate. A second dissenter means the internal coalition is cracking, and the 0.96 hold contract starts repricing for the next meeting. May 1st ISM, if the print lands below 50, the 18-point public-private gap resolves in favor of the book, and the manufacturing restoration narrative loses operational weight. That weight is what allows the tariff architecture to be sold domestically. Ninth Circuit this summer. If Nevada wins, the circuit split is explicit and SCOTUS cert reprices from 0.42 towards 0.60 or higher within 48 hours. Watch the book, not the court. July 24th, watch whether Section 301 findings arrive first, whether CIT rules first, or whether both clocks run out at once. That gate determines whether the pivot architecture gets a clean handoff or has to reinvent itself midair. Read those 4 resolutions as reconciliation events. They tell you which side of the guidance gap clears and how much longer the current pivot has before the next one has to stand up.
And here's what I'd add to that. The pipeline Marcus just described assumes the measuring instrument survives the measurement itself. Prediction markets are scheduled to render verdicts on 4 specific things, and those verdicts are being used to discipline the administrative narrative. But one of the 4 things being rendered, the Ninth Circuit decision, is a verdict on whether the prediction markets themselves remain legal. The instrument is scheduled to measure its own survival. If it clears, we have continuous pricing of public events as a durable mechanism. If it doesn't, the most sensitive thermometer we have for the public-private gap just gets dismantled by the side it's been measuring.
That's the recursion you can't unsee.
90 days, 4 gates. One of them is the instrument.
All right, everyone. Before we dive deeper into what these 90 days truly mean, I want to take a moment to sincerely thank you for tuning in. If you're finding this discussion valuable, please consider giving us a like, leaving a comment with your thoughts, subscribing to the channel for more insights, or even sharing this episode with someone who might benefit. Your support truly helps us bring these critical analyses to a wider audience.
Absolutely, Marcus. And to tie that into our discussion, the active engagement of a public, a viewership, is in many ways another form of the continuous pricing mechanism we've been dissecting today. Just as markets price policy outcomes, public discourse and the tension price narratives.
That's a fantastic point, Marilyn. It underscores how every layer, from federal policy to personal engagement, holds a specific kind of value at risk. We're watching the government stress test its guidance, and in a way, we're all part of that continuous evaluation.
Precisely. The stakes are immense, not just for the entities involved in these 4 gates, but for the transparency and accountability of how public events are understood and communicated. Whether the instrument survives its own measurement will shape the information landscape for years to come.
Indeed. So as we wrap up, keep those gates in mind, and remember that your active participation in understanding these dynamics is more important than ever. We're all observers, but also, in a sense, participants in what's unfolding.